All right, so good day from everywhere you might be hearing me from, and welcome to another session of tutorials. Please, if you can hear me, as a custom is, just give me the emojis. Let me know that you can hear me. Right. So thank you. I'm sure you are here with your pen, your papers, and every other thing that you need to learn. Like I was explaining at the tail end of the last lecture, that we are going to be meeting today to discuss IAS1 and the IFRS 18, which is the essence of why you are actually in this class. This is the core. This is the one that carries the highest of the percentage. I think in the breakdown of your syllabus, it carries about 30% of the weight. Likely, your question one will come from this IAS1 and IFRS 18 as it were. And then it's important for you to be attentive. It's a very simple standard. It's just the way it is, just as the name implies, preparation and presentation of financial statements. If you cannot prepare and present appropriate financial statement, then you don't have a need to be an accountant, as it were. Let me put it that way summarily. So this is the core, the bane of why you are called an accountant, as it were. So quickly, let's dive into it. IS1 and then IFRS 18, presentation of a financial statement. Now, the we used to have what we call IS1, which is of course still in existence, still much more in practice, still what we are still guided by in the way we prepare and present financial statements. IS1 talks about the framework that guides how to prepare the general purpose financial statement. But then there has been an introduction of IFRS 18, which is to formally repeal IS1 by 1st of January 2027. It was crafted in the year and issued in the year 2024, but it's expedient that accountants world over who, of course, adopted IFRS should be able to, get themselves familiar with the tenets and every of the details in that IFRS 18. It is not something that is alien to us. It's something that some of us might be familiar with. It's not something that is difficult, as it were. IAS1 and IFRS 18, they are all more or less the same thing. Basically, there are little adjustments, little, structured wise adjustment, as it were. And we'll look at it in this class so that you will be well grounded and detailed. And so let's dive again one more time and move ahead. Presentation of financial statement. Somebody asked me in the other class that what is even this presentation of a financial statement? Presentation of financial statement simply means how you are to structure each of the components of financial statement. How you are to structure them. What comes in this financial statement, what comes in this other financial statement, and like that and like that. That is just the simple meaning of a presentation. Presentation is what matters as to how someone will also use the information that you are passing to the user. So presentation matters to us as an accountant, and that's why you are in this class to learn appropriately. So as candidate preparing for exams this November diet, you should understand that IFRS 18 was introduced into the syllabus, and then it is expedient that students should learn how to go about the IFRS 18, as well as stay in line with IS1, and then draw strength from how to prepare and present a financial statement in line with IFRS 18. So we move quickly. IS1 and IFRS 18, like I said earlier, they are just to provide basically useful, reliable, comparable, understandable informations and to users. Very, very important. The essence and the objective is that whatever it is you are putting down in those statements, you are communicating an information to the user such that they can make an informed decision. That's the essence. You are preparing, you are presenting, whatever you are putting down. All that you are doing is to ensure that you are helping the users to be able to compare, to be able to rely, to be able to understand information that you are putting down. So IAS1, IFRS 18, basically they help users to assess the financial position of an entity, the performance of the entity, as well as how the cash is being moved around in and out of the cash over the period of time. So that is that for that. And in our conceptual framework, I remember that we talked about the components of a financial statement. Who can say recollect what are those components? Anyone here that can say recollect what the components are? The components of financial statement. I'm sure we mentioned it when we are treating the conceptual framework. Just raise your hands and then we'll call you quickly, please, so that we can have a very good time today.
Cash flow.
Anyone?
Statement of cash flow.
Okay. Maureen, you did not raise your hand. I did not call you, so put your hand down and then mute your mic. Shitu, please go ahead.
Statement of change in equity.
Start from the beginning, the way I taught you.
Okay. Statement of financial position.
That's one.
Statement of comprehensive income.
That's two.
Statement of change in equity.
That's three.
Statement of cash flow.
That's four.
Note to the accounts.
Thank you. Any other one? That's the five. Don't bother yourself. That's the five. Please let me clap for Shitu. I'm giving you 2 marks. Please claim it. That's a very good one. So those are the components of a financial statement. So when we say components, we are talking about what exactly sum up the total of the financial statement. So we have statement of financial position, statement of comprehensive income, which you can also call statement of profit or loss and other comprehensive income. If you are preparing as a single account, you can call it statement of comprehensive income. But if you are preparing as a double account, you can call it statement of profit or loss and other comprehensive income. As well, the statement of financial position is also the same that we know as the balance sheet. The nomenclature still suffices, it still remains. And then we have statement of changes in equity. Statement of changes in equity that measures whatever it is that happened at the beginning, what happened to the beginning of equity at the beginning of a financial year, and then what happened to it within the financial year, and then we have the balances at the end of the period. That's for statement of changes in equity. And we have statement of cash flows. Statement of cash flow tells us about the cash inflows and then the outflows. What happened with the cash? We are particularly concerned with what happened with the cash, the movement of cash in and out of the entities. And then we have the statement of policy, that's what I call it, which is also known as the notes to the accounts. So those are the 5 major statements that we have under IAS1 and the IFRS 18. Now let me tell you this. A lot of persons have been feeling that IFRS 18 is something that is bogus or something that is very difficult and dangerous. Then let me tell you for a fact, there is nothing in IFRS 18. The same thing that you have under IAS1 is what you are having under IFRS 18. There are only little adjustments, and that little adjustment comes and stems from a statement of comprehensive income. The way and manner it is being structured, that is the only difference. So your IAS1, if you are still familiar with it or you know it or you don't know it, IAS1 is still what it is in IFRS 18. The only thing that is now in IFRS 18 is we now have what we call presentation and disclosure. Presentation and disclosure. In other words, under IFRS 18 now, you are going to do your presentations and then you are going to give us disclosures. Disclosure simply means the notes to the account. You are going to make it more comprehensive than it used to be. And the essence is to be able to, give the users of the financial statement adequate information that is required and for them to make a quality decision. So that is that for that. Quickly, let's look at what exactly is in IAS1 and what exactly is in IFRS 18. So, key IAS1 requirements. You have fair presentation Under IAS1, we were told that it is important for us to represent whatever transactions or events that take place within the financial year faithfully. Very, very important. So we must have what we call a fair presentation. Equally, it is related that you must be able to comply with all IFRS principles. Very, very important. That is that for fair presentation. That is to say, whatever information you are putting down in the financial statement, you must do it faithfully. Faithful representation. That is to say, it is void of bias. It is something that a user can rely on. It must be fact and factual. It must be very, very expedient for quality decision making. It must also comply with IFRS principles, whatever it is that has been given to us in the principles according to how it has been laid down in the standards. All of the standards put together, we must always align with it. These are the key requirements. Number 2, for you to prepare and present any financial statement according to IAS1, an entity must assume the context of being a going concern. In other words, you are expected to be alive, that is, the entity is expected to be alive into the foreseeable future. Foreseeable future simply means we're expecting you to be alive for more than one accounting year. That is to say, we know too well that you've started business in January. And for you to say you are going to prepare a financial statement, it means that you will be in existence from January to December. That is what we call going concern. You are alive and you are doing pretty well. That is a going concern. So an entity is expected to continue into the foreseeable future. Then what about the accrual basis? Accrual basis simply talks about that the income and the expenses that you are to recognize, you are to recognize them when they are earned or incurred, not necessarily when cash is being received or paid. You know that for those that are doing PSAP now, under the government accounting system, they do not use this accrual basis majorly. They use the cash system. When cash is received or when cash is paid, that is when they recognize income and revenue. But under the IFRS guideline, we're told that under S1, we are to use the accrual basis, not necessarily when cash is paid or received before you can recognize income or expense, but once it is earned or incurred. Earned here simply means that, for instance, you sold good on credit. You know that you have sold the good on credit. Now you are to recognize revenue. That is very, very important. Not when you have received your cash. You are to recognize revenue because you have earned it. That contract has already exited between you and the customer. So you are to recognize the revenue. We know that the customer is going to pay at a future later date. You understand? So you must recognize revenue when it is earned. And then expenses, you must recognize it when you have incurred it, not when you pay it. You are buying on credit does not mean that you should not recognize your expenses as it were, your purchases as it were. That is that for that. And then consistency and comparatives. Consistency here means whatever policies that you are applying or that you are aligning with, remain with it into a foreseeable future. Don't change policies within or in between the financial year. For instance, you have adopted the use of straight line measure for your depreciation evaluation. You don't just in any way just wake up one night and say, okay, I'm going to change you to reducing balance method of depreciation. Whatever policies you have chosen to align with, remain consistent with it over the time. Then comparative of information, very, very important. Any information you are putting in the financial statement must be what someone or a user can compare, over time. We have various means of comparison. We have the comparison within the industries. For instance, if you are in the banking industry now, it is very important that you should be able to present or or give us information according to what you have done within a financial that can compare you with other entities within the financial sector, the banking sector. In other words, I can pick the bank statement of the statement, the prepared account financial statement of GTB and compare it with First Bank because they are in the same industry. Equally, we have what we call the time series comparative, which compares the years to year one of your accounting period to your year two. You understand? For instance, the account of 2023, and you're able to compare with that of 2024. In other words, you prepare your account in 2023 and you are preparing also in 2024. I should be able to compare your 2023 with your 2024 so I can see what has happened, what you have done, the changes you have made, the improvement you have made, or the recklessness that you have incurred as it were. So comparativeness of those information are also very, very important. And so also, you must understand that the structure of the component of financial statement, you have your statement of financial position. The statement of financial position is structured into the assets, equity, and liability. Please take note of what I've just said. You have under your statement of financial position, you have the structure to be your asset. Under your asset, you have the non-current asset first, and then you have the non-current asset as well. Please take note of that. Very, very important. So you have under your statement of profit or loss, you have your non-current assets, and then you have the current assets. Under the equity, you have all the line items that are there. Equity, your retained earnings, your reserves, they are all there. And then you have your liability. Under your liability, you have the current liability, and then you have the long-term liability. When we are breaking it down, you will understand how to go about it. Then you have your statement of profit or loss, which is also known as your statement of comprehensive income. Now, understand this. I was explaining it earlier. We have what we call the statement of comprehensive income. If you are preparing your financial statement as a single statement, that is your profit or loss, if you are preparing as a single statement, you are going to call it statement of comprehensive income. So you have your income being broken down to profit for the year and then other comprehensive income all put together. And then also you can as well do it. There is no compulsion. There is no mandatory statement under IAS1 that say that you must say statement of comprehensive income or statement of profit or loss and other comprehensive income under IAS1. All that you needed is to prepare your information according to how it is being detailed. Then in your statement of profit or loss, it is expected under IAS1. This is the key of the lecture today. Under IAS1, IFRS18, there are differences in how it has now been structured. Currently, we have this structure in our statement of profits or loss, where we have first the revenue. After the revenue, you recognize your cost of sale to get your gross profit. And under your gross profit, you have other income that you had to eat. And then you take all the other operating expenses, and then you take away the finance costs. Then you have your profit before tax, and then you charge your tax. And after you have charged your tax, you have profit after tax, and then you have other comprehensive income. The items under comprehensive income includes your revaluation surplus as well as your foreign exchange differences. That is how that is actually run. So please take note of that. It's very, very important that you follow through as I have explained. Very, very important, please. So under the new, please, I don't know, can you still hear me? Are we still together? Are we still together, please? Okay.
Yes, we are.
All right. Now, there are key updates under IFRS 18. Like I said earlier, the structure in let me redress it again. The structure under IAS1 for statement of profit or loss or other comprehensive income is this. You have your gross profit, which is determined when you remove your when you remove cost of sales from revenue, you get your gross profit, and then you charge all the expenses, as it were, the administrative expenses, selling and distribution expenses. You remove it, and then you get what we call operating profit, and then you take your finance cost, and then from there you have what we call profit before tax, and then you take tax, and then you have profit for the year. Now, under IFRS 18, it has changed. This is the only changes that came into being between IAS1 and IFRS 18. These are the main one. Other changes actually are there, but these are the key ones that you need to know. And what are these changes? Quickly, let's look at them. Under IFRS 18 now, we now have what we call the new subtotals. The new subtotals. In other words, we have what we now call operating profit, and then we have profit before financing and income taxes. These are the main structure that you have. So you have number one, operating profit. Number two, profit before financing and income taxes. And then this will now create different. We have three major headlines now that you now have under IFRS 18. We have what we call operating, just like you have it in your statement of cash flow, where you have operating activity, investing activity, and financing activity. So they have now bring it now to your statement of profit or loss, where you have operating, and then under this your operating now you have the revenue minus your cost of sales to give you what we call the gross profit, and then you charge your selling and distribution expenses, and then you charge your other operating expenses, then you arrive at operating profit. You must state it. You arrive at operating profit. Then you now carry another heading. You call it investing. Under that investing now, you now put down, maybe if there are income from your investment, you put it there. You understand? If there are other expenditures that have to do with your investment, you put it there, so you will let us know. And after that one, you will now go and charge all the financing cost or the interest and the likes. You put it heading, financing, put column, go there. If there are finance costs, you charge it, and then once you have done that, you are going to also have that one in place, and then you have what we now call operating profit. After that, you have what we call operating profit, and so you now charge your what is it called now, your tax afterward, and then you have what we now call, before you charge your tax, you have what we call profit before financing and income taxes. Profit before financing and income taxes, and that is after that one you will charge your tax, and then you now have profit for the year. So those are the new adjustment that was made. But that is the part A of it. The part B of it is that now there must not be a disclosure. There must not be a disclosure, and that disclosure is where we have what we call, that's what we call the notes to the account. In the notes to the account, you are going to now have what we call management performance measure. Management performance measure. And then example of it is where you will now need to adjust for earnings before interest, tax, depreciation, and amortization. You will disclose it. You are going to have it in your notes to account, where you will do the workings. When we get there, you will understand it better. But just understand that this is just the new structure that is being put in place under IFRS 18. The essence of why I'm explaining is so that you will have a basic understanding before we do or take any of the examples. So the new structure under IFRS 18 is, we have another headlines, operating. Under operating, we have your revenue, cost of sales, selling and distribution, and then you have what we call the operating profit. Then afterward, you go to investing. You write it investing. Then you put column. Then other investing items, you put them there. And then after that one, you go to financing. And under that financing, you also state it there. All those financing items, you state them via. So it's as simple as that. That's the part A of the new structure. And then the disclosure. You remember IFRS 18, the heading is presentation and disclosure. Presentation and disclosure. What I've just explained to you now is the new presentation that they bring in play, that they brought in view. Now, the second part of it, which is the disclosure, is where you have to tell us the defined measurement, the performance measurement by management. You have to disclose it and tell us. So you have to, all the subtotals now, you have to adjust them so that the public can have a quick view of what exactly you have been able to achieve in the year. And usually when you are asked to adjust for earnings before interest, tax, depreciation, and amortization, all that you need to do is to go to your profit before. If you are using profit before tax, you can use profit before tax. If you can also use profit after tax. If you are using profit after tax, it means that you are going to add back your tax, you are going to add back depreciation if there's depreciation, and if there is any amortization, you are going to add it back. And if there is interest, you are going to add it back, depending on the profit that you are using. If you are using operating profit, for instance, you may not necessarily need to do adjustments apart from depreciation that you will just need to add back. When we also get there, you will know how to deal with all of this. But in the overall, these are basically all that you need to know as an overview before we proceed into the calculation aspect of it. Any questions so far? Are we good to go? Can we go ahead? Do you understand all I've said so far? Thank you. So now let's dive into. Today we are going to mirror down and look at a statement of statement of comprehensive income, that is your statement of profit or loss. And the next class, maybe we just, if we're able to finish up and you understand it today, we'll move to statement of financial position. Why I'm taking statement of profit or loss today is that is where the major differences actually are in IAS1 and IFRS 18. So quickly, let's look at this example to demonstrate how we prepare our profit or loss under IAS1 and the IFRS 18. So now look at this example. Zach Gim Nigeria Limited has the following trial balance extract: revenue, cost of sale, admin expenses, selling and distribution, finance costs, investment income, tax expense. Tax expense required. Yes, the class is recorded, please. Required, present a statement of profit or loss for the period under review in line with both IAS1 and IFRS 18. We don't know if your question will come in this line, but I have to start preparing you just in case they surprise us and they bring your question this way. They may say prepare both. You understand? To test if you have the understanding. Thank you. So now look at it this way. Usually once you see this, you know that this is cheap for you under your IAS1. How do you prepare it under IAS1? Let's quickly go ahead. Under IAS1, the first thing first, remember I said the first thing you do is under IAS1, you recognize your revenue first, then you take your cost of sales to it, and then gross profit is what you have at the end of lesson your. Please, for those who don't know how to do it, the first thing first is to put down your revenue. Revenue is the first line item under your statement of profit or loss. And then in the question, we're told that the revenue is 50,000. And then the next thing that you take out of it is your cost of sales. Now, let me say this also categorically, that in some questions, they may not give you cost of sales directly. You are to determine your cost of sale. You are to determine your cost of sale. And your cost of sale is equals to, okay, let me ask if so that I will know that some of us we still know how to do it. Who can tell me how do we determine our cost of sale? Can anybody help us? Determination of our cost of sale. Okay, Maureen, go ahead.
Good afternoon, sir.
I can't hear you.
Good afternoon, sir.
Go ahead, please.
Okay, for you to get your cost of sale, you consider your opening inventory.
Okay.
After opening inventory, you add your purchase.
Okay.
After adding your purchase, you less closing inventory.
Okay.
And you have your cost of sales. Thank
So
you.
how do you treat return inwards and return outwards?
Sir?
Because how do you treat return inwards and return outwards? Because that is where the chunk of issues are when they bring some questions at your level. Return inwards, return outward. How do you deal with it?
Okay. I think
If you
rich.
if you are not sure, let's call on another person. For what you have just done, I'm
Okay,
giving you
sir.
1 mark. Any other person want to help Maureen out? Maureen, you can mute your mic. Okay, Kingsley, go ahead.
Okay, return inwards is subtracted from sales, while return outwards is being marketing, right? Yeah. Return inward is subtracted from sales, and why return outward?
Okay. Town Abodrin, please go ahead.
Is added to the cost of sales and return outwards.
Please come again. I barely can hear you.
Return inward is added to cost of sales. Return outward is reduced from the cost of sales.
So where will you treat it? Now, return inward will be treated where? Is it to purchase or to closing inventory?
Return inward is closing inventory. Return outward is purchase.
Okay. So please, for those, for the sake of you people that may not know, when they say return outward will only happen because you are buying from outside. Return outward means that maybe an item that they give to you is not okay with you. You return it back to the person that supply it to you. You return to supplier. So, and because you are returning to supplier, remember that is with purchases. Is that not so? So once you return it to the supplier, you remove it from your purchases. Please take note of that. Then returning what? You are the one that said they are now returning it back to you. You understand me now? That is what we call return inward. So what do? You add it back to where? You are not answering me.
Cost of sales.
Add it back to
Sales.
closing inventory. Add it back to closing inventory. Please take note of that. You less return outward from purchases, you had return inward to your closing inventory. Is that taken? Can we go ahead?
Yes, sir.
All right. So that is that for that. For those who don't know how to calculate, please be handy with what I've just said now. So that is that for that. So we have revenue there. We less our cost of sales. We were told that the cost of sales is 30,000, and then we have our gross profit to be 20,000. And then we were told that there is what we call in the question investment income of 500. Under IAS1, we used to call this investment income other income. So that's why you will see it other income. Then you put it there, other income. And then you now recognize all the operating expenses. Your operating expenses mainly are admin expenses as well as selling and distribution expenses. Other expenses can come to bear, but these are the main operating expenses. So operating expenses are the direct expenses that has to do the overheads that has to do with the operations of the entity as it were. So please take note of that. So now from there you charge your finance cost. Do you understand? And then you have profit before tax. So there are no, under the IAS1, there are no mandatory requirement for you to identify your profit before tax and the likes, or operating profit and the likes. All that you need to do is ensure that you appropriately, put down all the items as they should be. And that is that for that. And then you put your tax for the year. And once you're able to charge your tax for the year, what you will have is what we call the profit for the year as it were. That is under IAS1. But under IFRS 18, it has changed. It has what? Changed. And what do we do now? Please, just quickly scan through how we did this one now. When you look at it, you have revenue, cost of sales, we give you gross profit. Hard other income, less operating expenses, and the finance cost, you have profit before tax. Now, in the new IFRS, there is nothing like a profit before tax. Rather, you are going to have what we call operating profit and profit before tax. So that is that for that. So under IFRS 18, how is it now structured? Look at it now. I told you we now have 3 major headlines under the new IFRS 18. We have operating, and then we have investing, and we have financing, just like you have it in the cash flow. So under the operating activity now, or let's put it operating item as it were, you have revenue. There, you charge your cost of sales, you charge admin expenses, you charge selling and distribution expenses, and then what you will now have is known as operating profit. Under the IAS1, if you don't put operating profit, nobody will penalize you. But now it is now mandated that you must recognize operating profit. Operating profit simply tells us what you have done with the available income and the expenditures that you have made. What you have done with the available income, the turnover you have made. It tells us the revenue you have generated, as well as the expenses that you have incurred. You understand now? And that is how to go about all of these. So you have your operating profit. Then afterward, you now have what we call the investing activity, or the investing item as it were. Like in IS1, we say this investing income will be what? Other income. But that is not how it is now under this IFRS 18. You must write investing, and then investment income, you must recognize it. This investment income usually are maybe dividend from your subsidiary or joint ventures or other business that you are engaged in doing. You understand? They may not tell you it's investment income. So you must be able to know what are the constituents of this investment income. I'm just giving this as an example. We are still going to look at an holistic example whereby we are going to do workings, because the essence of presentation is that you don't model up and bring all of those line items. That is where aggregation come to play. You understand? Under IAS8 and IAS1 and IFRS 18, it is expedient. Aggregation is what they take into considerations a lot. Aggregation simply means pulling all the similar items under one particular heading, one particular headline. Similar items, of the same nature. For instance, all income, or whatever it is that constitute revenue, for instance, put them under revenue. Whatever it is that constitute cost of sale, put them under cost of sale. So that's where you are now going to have notes to the account. So this is under disclosure. So IFRS 18 really stress more on aggregation and then disclosure. And this aggregation must be done in your disclosure. So you must be able to tell us note by note what exactly constitute all those line items in your financial statement. You must tell us note by note. Note 1 is when you're preparing your financial statement, for instance, statement of profit or loss that we are looking at now, under your revenue, if you have done any adjustment, you must tell us. You must refer us to notes. That is the notes of the account. Note 1, you must tell us. If it's cost of sale, you must tell us. So please take note of that. Then we are now under, I hope that is understood, please. That is what we call aggregation. Some of you may be saying, what is aggregation? Aggregation simply means uh, pulling together all items of the same nature under the same heading. That is aggregation. And then there's also what we call disaggregation. Disaggregation simply means, the items that the way you are structuring the items in the financial statement. That's what we call disaggregation. In other words, you have operating item now, you have investing item, you have financing item. That is the disaggregation. Town, you are raising your hands. I thought you are answering questions the other time. That's why I didn't call you. Do you have questions? If you don't have, just put down your hands so we can quickly look at this. Thank you. So now that is investing items as well. So investment income. Then you have financing items. That talks about the finance cost in the question. Look at the way the question is and look at the way they have now structured it. Now, if you look at it clearly now, you will see that we are still going to arrive at the same profit for the year. But if you check this IFRS 18 now, it is more structured, more mature, more professional than the way we used to have it, where everything is just modular. You don't even know which is which. Do you understand now? So it is clear, the subtotal are clear, so you have everything in place. So when you have your operating profit as 13,000, then you had other income to hit, you have 14,000, you remove your finance cost from it, you have 12,000. That's what we now call profit before financing and income tax, and that will be what we call 12,500. 12,500. Please take note of that. After your profit before financing and income tax, that's when you will now charge your tax expense for the year. And after your tax expense for the year, you are going to have the profit for the year. Please digest this. It's very important for you to digest it. Let me go over it again for the sake of those that might need further explanation. Let's go to IAS1, or quickly let's look at the question. The question is the same thing: revenue, cost of sale, admin, selling and distribution, finance cost, investment income. Now, if you are to prepare it under IAS1 revenue, under IAS1, all that you need to do is there is something I left out when I was explaining something to us. Please, okay, let me just quickly round up with this, and then I will come back to that very, very important headlines that I said I forgot to mention. Now, under IAS1, you have your revenue, cost of sale, and then you arrive at gross profit. Put other income there. Other income can be any other income like gain on the disposal, all those ones. You understand now? They are part of other income under IAS1. But now, that is not the way it is under IFRS 18. So take note of that. So you add your other income, charge your admin expense, selling and distribution, finance cost, you have profit before tax. Charge your tax, you have profit for the year. This is direct and there's more modeled up. It may be simple to you, but users are finding what is all these things that you are just putting here. We don't understand. And that is why, in the wisdom of IASB, they have been able to go to the drawing board and come up with IFRS 18, which now give us a good future, well structured for users to be able to understand. Because what is the essence of you preparing an account that the users cannot understand? So that is that for that. And so now the same content of information that was given to us, we have been able to use it to prepare under IFRS 18. But I told you, IFRS 18 now do what we call, they structure the entire statement of statement of comprehensive income into four basic headlines. You have the operating, you have the investing, and the financing items, as well as the fourth one to be other comprehensive income. Then under your operating activity, you have to recognize your revenue, your cost of sale, admin and selling distribution to arrive at your operating profit. Please take note of that. And then you now have your investing items. Under this investing item, that's where you are going to recognize your loss or gain, your your loss on disposal and any other line items. And then this investing also, you recognize if there are dividends that were paid to you, you recognize as an investing income. So this investing income now will now form a note because you have to do it as a workings. Then whatever thing that comes under it, you bring it there. Then financing now, you have your finance cost under your financing. You also bring it there. And then you arrive at what we call profit before financing and taxes. Profit before finances and taxes, income tax as it were. We're in I think the previous class we have been able to look at IAS 12 income taxes. Please watch the video. I'm sure it has been uploaded now. I wouldn't know, but I think it has been uploaded. If it hasn't, it will drop today and today. So that is that for that. So it's as simple as this. It's not something that is difficult. So please, I want to create another link now. I will send it across to us so that we can join. I wouldn't know why this thing is giving me 1 hour since yesterday again. But so please just take note. I will create another line. We'll send it there right away, and then we start with another question. Please, Ebere, you are raising your hand. You can go ahead and ask your question. Ebere.
Hello, sir. Sir, good afternoon. Okay. Yeah, under the financing cost, they will now under it again. We now have profit before financing and tax. Does it mean we did not deduct the finance cost before the tax?
Now that is what. If you check this question now, we have operating profit will be 13,000. Then investing to be 500. If you have 13 to 5, you have 13,500. Finance cost is an expense. When you less it, you now have what we call profit before financing, income, and income tax. So what they have said now, because I asked that questions over time, they said no, let us put it this way. Profit now, when we're actually looking at the brainstorming with some other persons, you know, they told us that this is what they want us to put down. Profit before financing and income tax. That's how we should put it. That's how the schedule put it. That's how IFRS18 put it. That we should put it that way for them. Profit before financing and income tax. So this is how it is structured. Just get used to it. The nomenclature, the way it is called, just get used to it this way. Is that taken?
All right. Yes, it's clear, sir. Thank you.
All right. Any other question, please? All right. Welcome back, everyone. And I think we formed a quorum already. So let's just continue from where we stopped. Now look at it. I was saying something about what we need to note. Very, very important. Please, when you are presenting any of your financial statements, a component, please, there are 4 key things that are very, very important that I skipped at the introduction when I was giving you the overview. Please, very, very important. These 4 things are very, 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 very important. Number 1 is you must always write the name of the entity. Name of the entity. Very, very, very important. That's number 1. Number 1, you must always state the name of the entity. Are we still together? Very, very important, please. You must always state the name of the entity. You must always state the name. The name is very, very important. Please take note of that. So that is number 1. The name of the entity. Number 2, you must always tell us the period.
Is some people hearing something? I can't hear.
Hello, hold on, please. Hold on. Okay, so like I was explaining before, the loss in transmission. So these are the key things, very, very important for you to know what you must do in your exam. Please, see this particular standard we are looking at, we are much hopeful that it has been the question one in the last 4 or 5 years, and I'm still much hopeful that it will be the question one in this November diet. Like I will always advise students when you are writing this FR exam, please, once you get to your exam hall, you pick up the question. They give you the question. Don't start reading from question one. Go and start reading from question 7. Read from question 7 down to question 1. But make sure that you attempt question 1. Very, very important. You must always attempt your question 1. But my advice to all of my students has been, and before you start question 1, ensure that you have been able to attempt at least 3 questions. The reason is simple. If you start with question 1, I bet it you may not answer or attempt more than 2 questions before the time is off, because adjustments are going to take your time. You may know it, you may know everything there, but please just make sure that you attempt question 1. Why am I saying this? It is important that you attempt 5 questions out of 7 questions. These 5 questions that they ask you to attempt, please make sure you attempt them. Very, very important. Whether it's A or B or C that you know in a question is an attempt, attempt it. Do you understand now? But you see this question 1, if they bring presentation of financial statement, please, once they bring it and it's in your question 1, you can as well write and attempt the question 1 before and put it on the first page. You can put it there. You know the name of the company. Always just attempt. That's what I want to say. And what you are to put there, even if you don't know anything in question 1, these 4 things that I want to mention, if you put it there, at least you are sure of 1 or 2 marks. That's why I'm emphasizing it now. What are those 4 things? Number 1, the name of the entity. For instance, Peter Jimmy Nigerian PLC. Please put it there. The period under review. Do you understand me now? The name of the entity, the period under review, please. Sorry, it should be number 2 should be name of the statement, and the period under review. Name of the statement and period under review, and the period under review. This is the number 2. It must be well stated. Very, very important. Please take note. It must be well stated. Name of the statement and the period under review. For instance, we are looking at the statement of comprehensive income. You must state it. Jimmy Nigerian PLC, statement of comprehensive income for the year or ending 31st December or for the period ending 31st December 2021. That is the number 2. Number 3 thing that you must state is the currency. Currency, very, very important. The currency, what is it called now? The denomination that you are using, you must state it. Please, very important. And then the 4th thing is the rounding of figure. The rounding of figure. You must tell us the rounding of figure. If you are rounding off a million, state it. If the question states rounding off a million, please state it rounding off a million. If the question states in thousand, state it in thousand. If you state it in billions, state it in billions. Please, this is very, very important. That is number 1. Number 2 is this. Presentation of financial statement can be for single entity or double or more entity. When we have single entity, the explanation I've been giving so far covers out of a single entity. Single entity means I am one entity, like Peter Jimmy Nigeria Limited. You understand now? But when it becomes double is when you are required to do what we call consolidation, which you know as a group account, where you combine 2 or more components. Timothy, please, I'm coming. Where you combine 2 or more components together. Either way, whether it is a single that you are preparing or double that you are preparing, this heading that you are saying, this 14 that I've just given to you, you can earn 1 mark from it. And if you also do not put it there, you are any copies that you do, you are going to get 0. That I assure you. Is that taken? Thank you. So, Timothy, please, you can go ahead and ask your question.
Good afternoon, sir.
Good afternoon.
Under the IFRS 18, the profit before financing and income tax, I think it should be 13,500 naira. Why profit before income tax should be 12,500 naira?
Did you follow us from the beginning?
Yes, sir.
Now, let me buttress a bit now. Please, you can mute your mics. Mute your mics, please. Now, let me buttress why the reason why they put this profit before financing and income tax. I told you that IFRS 18, the headline is presentation and disclosure. The presentation talks about the structure, what the new structure in the statement of profit or loss, where we have operating, investing, and financing. And also, that talks about the structure. Now, for the disclosure, it is expected that every statement of financial, every statement of comprehensive income that you prepare, there must be a note in the account that tells us what we call the performance measurement, management performance measurement, MPM, management performance measures. You must state it in the notes to the account. And then what does that imply? You must be able to tell us what exactly is the earnings before interest, tax, depreciation, and amortization. You must tell us what that earning is. And the reason is this: we want to know, that those interests are statutory payment that you must make. We know that. Your taxes, they are statutory payment that you must make to the government.
I'm not
Are we still together?
hearing you.
We are hearing you.
It might be your network, Chikodi. Please just change the direction of your network. Thank you. So, your earnings before interest, tax. Are we still together?
I think you should. Yes, sir.
Yes, sir.
Thank you. So now in your disclosure note, you are to do a little of adjustment. And that adjustment is you must tell us, for instance, your earning before interest, tax, and depreciation and amortization. Like I was explaining, the interest, the amount that you must pay, whether you make profit or not, you must pay it. Is your interest. You have to pay to the to your lenders. Is that also? That is it. Tax is what you must pay to the government. You understand now? Whereas depreciation and amortization, they are not recognized by law, and then they are what we call non-cash item, which is in the statement of profit or loss. So you have to add them back so that we will know exactly at the what is the original earnings before interest and tax. So that we then the adjustment that you will now make after you have added back all this, for instance, the amortization and depreciation, now you have added them back, and all these provisions, you have added them back. Whatever it is that you have now, further adjustment that you are expected to make, but at your level now, you may not need to do it, maybe at the professional level. At the professional level now, when you get to professional, when you are doing SBR now, there are other adjustments that you have to make. Like you will now take away the interest, take away the tax. You understand? Once you take these items out of it, then we will now know what exactly is the original earnings to the organization. You know, these earnings now can be used to make a decision that are required by the users. So the reasons why they put this profit before financing and income tax in IFRS 18 is when you are making an adjustment now, you are only going to add back, for instance, you know, this financing now, that is the interest. You are going to add back only the interest, and if there is depreciation and amortization, you will add it back. You will not add back income tax. Remember, you are going to be stating this in the notes to the account. So what you are going to now carry will be profit before financing and income tax when you are doing the adjustments or the workings in the notes of the account. And then you will now, if there is depreciation, you will add it back. If there is interest, you will add it back. If there is amortization, you will add it back. So you will not need to add back tax again. That is the essence of this profit before financing and income tax, why they put it here under IFRS 18. Do you understand it now? So that is that for that. Any other question? Can we proceed to another, to see
Yes,
another
sir.
question?
Yes, sir.
Thank you. So now let's proceed on look at another. Okay, look at what I was trying to explain now. Suppose we are asked to prepare a management report. Management report is the management report of that talks about the performance measure. Management report of performance. This is how to do it in your notes of the account. Look at it now. Profit before financing and income. In the question that we are looking at is 12,500. I assume the depreciation is not given to us in that question. I was going to assume it. Add depreciation back. We have earnings before interest, tax, and depreciation. Take note of something here. Look at it here. Like my friend was trying to point out, he said, why don't we have profit before tax since we after this financing cost? Now look at it this way. Operating profit is 13,000. Investment income is 500. That's 13,500. If you now remove this finance cost, you have 12,500. So now that you are having this 12,500, instead of you now adding back finance cost, this finance cost, it is a must that you will pay it, whether you make profit or not. Instead of adding it back, you don't need it. Just carry what you have put in front of your financing and income tax. Carry it, and if there are depreciation and amortization, you will just add it back. It's as simple as that. Any question? I'm sure there is no question. So look at this exam tips in case you are asked in your exam. Before we take another question, always start with IAS1 format in case you are asked to prepare in line with IFRS 18 and IAS1. Always start with IAS1 format. There you go ahead and explain the modification to IAS1 with IFRS 18. Then you use examples of subtotals and then the management performance measures, you know, when you are answering your questions. Very, very important. Please, I'm the one begging you now. Please, take note of what I have just explained. Any question? I'm sure there is no question. Let's quickly look at this question. The draft trial balance of Zenith Manufacturing PLC, a listed company, is presented below for the year ended 31st December 2023. Are we still together? We have revenue, cost of sale, distribution and selling expense, admin, research cost, investment income, and then you have finance cost, depreciation, gain on disposal of PPE, restructuring cost, tax expense, PPE net book value, intangible asset, inventories, cash and bank, trade payables, other liabilities, 6% loan notes, share capital, retained earnings. Additional information. Management present adjusted operating profit in investors' communications, excluding restructuring costs, gain losses on disposals of PPE. The company has not yet adopted IFRS 18, but wishes to understand how its financial statement will change compared with IAS1. Required. Prepare statement of profit or loss for the year ended at the 1st December 2023 in accordance with IAS1 and in accordance with IFRS 18. Be prepared. Okay, we have not done financial position, so we will not just prepare the whole. We'll just look at the part A of this particular question. Is that also? Or let's look at the requirement. C, show how management define performance measure, that is adjusted operating profit, will be disclosed under IFRS 18. Please, this C is very, very important. How management define performance measure will be disclosed under IFRS 18. It's very, very simple. That's where you have that your earning before interest and tax, you add back depreciation, all the other items. You see how they do it. And then what are the advantage of IFRS 18 and compare with IAS1? You understand? This question is a likable question. This is how likely your question will be formatted and given to you. And that's why I'm bringing this up now. So let's look at it. How do we attempt and how do we deal with this question? Can anybody try to help me prepare IAS1 in line with IAS1? Can anybody try, or would you all do it together? We should do it together.
Let's do it together, sir. Let's all do it together. Yes, sir. Let's do it together.
Yes, sir.
So now let's go. In line with IAS1, the traditional way, I told you, please always state the name. The name is Zenith Manufacturing PLC, statement of profit or loss for the year ended 31st December 2023. Please. This thing that you see here is 1 mark, as you are seeing it. So 1 mark. Now with this Zenith Manufacturing PLC, statement of profit or loss for the year ended 31st December 2023. You can write it this way. Nobody will penalize you. You can as well put it down the way I put it down. Nobody will penalize you. Please take note of what I have just done. So that is that for that. And then we have our revenue. Okay. I've already done it down. I think for the sake of speed and time. So let's just follow what I've done. Revenue. We're giving revenue from the question. Our revenue is 360,000. Look at it, it's under the credit side of the trial balance. 360,000. Cost of sale 240, distribution 24,000, admin expenses, research cost, and investment income. This one is also under credit. Gain or disposal of PPE 6,000. You can see it's also under credit. Restructuring cost one-off 10,000, tax expense 18,000, like that. So now under this our solution, we can see it here. Gross profit 120,000, investment income 45, gain on disposal of PPE 6,000. Now these are the traditional way of doing this. The traditional way under IAS1 of how we are doing or computing our what is it called now? Our items. Please, Peter, you raise your hand. Go ahead, ask your questions.
Okay, thank you, sir. Good afternoon, sir.
Good afternoon.
So I wanted to ask, the cost of sales, were we given there? Was it a figure or maybe it was part of the adjustment?
No, it was given in
the
figure.
cost of sales.
It was given.
Okay, it was given in figure.
The question, yes. Please, whenever I present a question, just snap it so that you can follow through. Let me go back again. Look at it here. We're given. Look at it.
Okay.
So you can snap it so that we won't be referring back and the like. So that's that for that. Then you now have your cost, gross profit, then investment income. That is the dividend that we pay 45. Gain on disposal is part of other income. You understand? Assuming, okay, when we get to IFRS 18, you will see how we do it now. We just do adjustment, we bring it in. So that's that for that. Then total income will now be, sorry, please. This is not supposed to be here. So other income 6,000, and then total income will now be 130,000. Then you less your selling and distribution. Let's call this operating profit, which is not necessary, but let's call it operating profit for the sake of understanding. So we have it. Please check for me if my calculation is correct. 240 minus 360, that will give us 120. Yes, correct. And then, okay, it's actually correct. 130, 500. So we have operating profit. No, that will not be operating profit. This is income before selling and distribution expense. Income before operating expense. That's the 130,500. Then you have your distribution and selling expense 24,000, administrative expense 36,000, research cost, restructuring cost, depreciation, finance cost, and then when you less all of these, you're now going to have what we call profit before tax. Please help me check the calculation if I'm also correct. Profit before tax of 22,000. Then you have your tax expense of 18,000. When you also remove it from it, you have a profit for the year 4,500. Please help me check this calculation of mine. I'm sure I am very correct. So under IAS1, operating profit is not important. It's not mandatory. You don't need to disclose it. Is that taken? Please, do we understand what I've just done here?
Yes, sir. Yes, sir. It's correct. The calculation is correct.
Thank you so much.
It's correct, sir.
So that, please ignore any noise that you are hearing. Please just ignore the noise. Let's focus on what we are doing. And that is that for that. So can anybody just help me try to do it in line with IFRS 18? Oh, don't worry. Let's do the IFRS 18 for this one. I will give you a class work now. All of us, we are going to do it together. System of finance for the year ended. Okay. Yeah, this way. So we have our operating items, or just put operating. So you have revenue, cost of sales, gross profit, distribution and selling expenses, research costs, restructuring costs, depreciation, and then gain of disposals. All of these, now we have what we call operating profits. Can we see that? In line with IFRS 18. Did we see it? Are we seeing it? Now, let me also say this. The reason why I bring all of these research costs, restructuring costs, depreciation costs as line items is because of the adjustments that we may need to make when we are doing our management performance measure. You understand now? But ordinarily, instead of me bringing all of them into this place, I can put them under other operating expenses as a workings, and then I will call it maybe note 3 or note 4 now. Then I'll put it there, note 4, other operating expenses. Then I'll bring research costs there, restructuring costs there, depreciation, and gain on disposal. Also note that depreciation can be inserted under distribution and selling expenses if it has to do with depreciation of motor van. You bring it there. If they are silent, or they can as well tell you where to put it. You can as well put depreciation under administrative expenses. Please take note of that. You can put it under administrative expenses. You can put it under distribution expenses. Under distribution expenses, if it has to do with a motor vehicle that is being used for distribution expenses, as it were. Please take note of what I have just said. Thank you. Any question before we proceed?
Sorry, hello, sir. Sorry, it seems I lost. Sorry, sir. It seems I lost your explanation while you are trying to explain how we can categorize the depreciation. You said we can put it under admin.
You can put it under.
You can put it under operating.
You can put it under other operating expenses. You can put it under admin expenses. But the one that has to do with distribution, the distribution that you can put under distribution and selling expenses is the one that has to do with motor vehicle that is used for distribution and selling. But I'm sure that if they want you to put it in distribution, they will tell you. If they want to put it in admin, your question, they will tell you. But in case they are silent, you can put it in any of these three. But please note, the one that you can put under distribution and selling is the one that has to do with distribution and selling itself. Please take note of that. And then, if they are silent, you can put it in administrative expenses, or you put it under other operating expenses. Chikodi, you are raising your hand. Go ahead.
Okay, please, I want to confirm, why do we have gain on disposal of PPE under operating expenses?
Now, instead of what?
Do you get me, sir? I'm asking, why do we have gain on disposal of PPE under operating instead of investment activity?
No. You see, under this IFRS 18, the items that they are emphasized on are the dividend that is received from subsidiary and other joint ventures. Do you understand now? Then other incomes are to be categorized under operating expenses. Let me take it again. The major income that is being recognized under IFRS 18 currently is the dividend that you receive from a joint venture or associate, or your other investment you have in other companies. That is the only investment income. Please, not subsidiary. I mentioned subsidiary, that was wrong. Not subsidiary. Please take note. Is your joint venture or associates. Please take note of that. So that is the only one. But all other income are to be recognized under operating items. The reason is also simple. If you check, the PPE that you are disposing, is not the PPE that you are turning over. It's the PPE that you are turning over for your operations. Do you understand me now? So you are not disposing part of it that you are no longer using again. You recognize the gain here. And if it's a loss, you also recognize it in this particular place under operating items. Is that taken, or operating activity, as it were? Is it clear enough, Chikodi?
Yes, sir.
Thank you.
Yes, sir.
So now let's proceed. So we now also have the investing income. The investing income, that's the dividend that was paid. The dividend that was paid. If you check, I said dividend. So it's in that structure. You see there? Where is it? Yes, investment income, dividend. So please always take note. Very, very important. Is majorly dividend. Please, you can mute your mic that you put there on as other income. Please mute your mic. So that is that for that. Then the financing is just usual interest expense. Now, please, if you check, I put in the bracket interest expense. Sometimes they may not say finance cost, but note that finance cost is the same thing as interest expense. So interest expense is the same thing as finance cost. Note that. And then you arrive at what we call profit before financing and income taxes, and that is 18,000. And then, 22,500. You charge income tax for the year, and then you arrive at 4,500. Please take note of all of these. They are very, very, very important items that you need to know. Please. Is it clear enough? Is this clear enough? Thank you. Jimmy, is it clear enough? Peter, Jimmy, are we
It's clear.
still good? Okay.
It's clear, sir. It's clear, sir.
Only
Very clear.
Ayo.
Hello, sir.
Okay. Go ahead.
So I just want to buttress. Sorry that I couldn't start from the beginning, but based on what I'm observing now is that maybe this IFRS 18 is trying to go in line with the statement of cash flow. That the way we are doing the cash flow, this one too, the cash flow is being divided into 3 segments, which is operating, financing, and investing, and which is the same thing we are doing under the P&L here. So if you have the idea of the way we've been treated the cash flow, I think it will help here. Just that this one doesn't involve the cash. Thank you, sir.
And that is how it is. Like I mentioned earlier, I said it's just as how you have it in your cash flow. That's how they have brought it now under IFRS 18, and so that you can have, what you are. If you are presenting, for instance, cash flow statement to users, and you are saying operating activity, financing activity, investing activity, what stops you in recognizing it in your statement of profit or loss that same way, so that the consistency will be there for users and people can understand whatever it is that you are putting down. I think that is the reason why IFRS 18 is coming up with this particular structure in how to recognize these line items in the center of comprehensive income. Thank you so much, Wolafe, for that additions. So that is that for that. This is how simple this thing is. It's not something that is difficult. If they ask you to present it in line with IAS1, this is how you just do it. They say you present it in line with IFRS 18, this is how to do it. Do you understand it now? Any question?
Yes, sir. Hello, sir. The IFRS 18, when is it coming to life? I mean, to be using in organization implementation.
According to the Accounting Standard Board, we were told that it will come into effect on the 1st of January 2027, but earlier adoption is permitted. Earlier adoption means in your country of jurisdiction, if your reporting council says start, but we are being guided by Federal Reporting Council of Nigeria. They have not told us that we should start using this particular standard. You understand? So that it will now repeal IAS1. Do you understand? So until we were told, we won't go ahead to do it. But it is important for us as accountants. We should be trained on how this standard is going to be, and they are starting with you people in this diet. So they may want to test. They may not tell you to prepare. I don't know how the question will be said. That's why I'm preparing you on both sides now. Just in case they say prepare in line with IAS1 and IFRS 18, you will know how to do it. The only adjustment that is being made under IFRS 18 is in the statement of profit or loss, where you now have 4 headlines now. You have operating items, investing items, financing items, and then you come up to what we call profit before financing and what is it called now, and tax. You charge your tax and then you have profit for the year, and then you now have other comprehensive income. The other comprehensive income is not tampered with. It's still remaining the way it is. Then your balance sheet is still remaining the way it is. Your statement of changes in equity is still remaining the way it is. Your statement of cash flow is still remaining the way it is. It is only your profit or loss that the adjustment were being made. Chikodi, you are raising your hand. Go ahead and ask a question. Okay. I think it was before, right? So now I want us to look at this particular question C in this question that we are looking at, because that is also one of the way they can ask you questions in under IFRS 18. They said, Where is it? C. Show how management defined performance measure, NPM, will be disclosed under IFRS 18. They can tell you adjusted operating profit. That's why I put it in bracket. Or they will say management defined performance measure. I'm sure they will not use the word adjusted operating profit so that you won't even know what to do, so that they can as well confuse you. But if they say management performance measure or management defined performance measure, the best way to always do the calculation is to adjust the operating profit. And how will you do it? Very, very simple. Just carry that profit before financing and taxes under IFRS 18. Just put that figure there, profit before financing and income taxes. Put it down. Add, if there is a depreciation and amortization, you add it back. You understand now? Now let's look at how to deal with it under this particular question that we are looking at. I've done it there. You will see how I did it there, so it will be very, very easy for us to look at. That's the question C now. Where is it? Look at it here. Reconciliation of adjusted operating profits. Operating profit is 30,000. You now less gain on disposal of PPE. Why? Because that gain on disposal of PPE is not part of your activity for the current year. It's not part of your activity for the current year. Please take note of what I've just said. You dispose PPE. It's not part of your activity for the current year. So you less it from the operating profit that was made. Then, look at it here. You are going to add back restructuring cost. The cost of restructuring, you have to add it back. You add it back. There's something I've also omitted in this particular question here. There's supposed to be an addition of depreciation. We're going to also add back depreciation. Now, why are you adding restructuring costs? I thought somebody is going to ask me that. Depreciation. How much is that depreciation, please? Can anybody still remember? Why are we adding back restructuring cost? Depreciation is 18,000. So the depreciation is 18,000 at the back. Please, I'm coming. I know you raise your hand. I'm coming. Okay. 18,000. So please, what's the new figure now? Are we together? Let's gain on disposal. You have 24,000 plus 10, 34 plus 18. What will this new figure be? 62, I guess, if I'm right. Are we still together?
Yes, sir. Yes, sir.
Is 62 correct?
52.
Okay, 52. Thank you. So that is how to do your adjustment. Now, restructuring costs, why are we adding it back? The reason is simple. You are not, you said you want to restructure. You have not restructured. The restructure will take place in the next financial year. So why are you taking it from your expense now? I mean, why are you taking it from your profit in this current financial year? Do you understand? So that is why we are adding it back. So the performance measurement is reflecting some of those items that will not help you to future well, that will not help your statement to look tidy. You understand me now? For instance, by the time you remove all of these items, you are not depleting your profit. When you now deplete your profit, you are not making us to see sense in the in your activity as it were. So it is important for us to know exactly what are the cross of what you have gained. What exactly have you gained over the financial year that you have carried on business? That's why you see that a lot of activities are being, are not being well handled with tax authority. Tax authority, for instance, they are not okay with some of these items that we recognize in our financial statement, and it's always giving us differences and claims and what you are to pay back and the likes. So these are the core reasons why I believe IFRS 18 have made so much adjustments to some of the presentations in line with IAS1. Okay, Owolafe, you are raising your hand.
Yes, thank you, sir. I just want to get better understanding of this MPM. And based on what you just explained and to my own understanding, I discovered that what this MPM is talking about is giving us the position of tax assessment. If that is, if whatever we are getting, you just want us to know the true picture of what is happening, what is actually attributable to the current year. Anything that is in future is taking it out. Like
Yes.
this PPE now, the depreciation. I think why are we adding the depreciation, to my own understanding, is that because we've been giving the capital allowance. I think that's why we are adding it. I'm just trying to my own understanding, that's why we are adding it back. Since the capital allowance has been provided, that's why we are adding it. Then the restructuring cost, because this thing has not been actually incurred. So we are planning towards the future, and it's not even relating to the current financial period.
Yeah.
That's
Yes.
why I just want to. Okay, thank you, sir.
You are very correct now. That's how it is. It's as simple as ABC. Please take note. Everything that we have discussed so far is not something that is difficult. Just understand the basic. That's why I said I gave you the exam tip. The first thing first that you need to understand is how exactly is the account going to be prepared if we are using IAS1, the traditional way, which is usually you determine your gross profit, determine your operating profit, profit before interest and tax, that is operating profit, then profit before tax, and then profit after tax. That usual way of you determining it. Except if we are saying that at this level now, we don't know how to determine it. Please let me, so that it won't be as if I'm assuming that you know it and then you don't know it. I'm sure every one of us will know how to prepare statement of profit and loss account in the traditional way, where we get our gross profit, our profit before interest and tax, profit before tax, and then profit after tax. Do we know how to do it? Do we all know how to do it? I want chorus answer. If you don't know how to do it, just say I don't know. So I will just assume that I will just assume that you know it, and I've just been explaining, and the thing is not sinking. Please, statement of profit or loss account is the most simplest of all. That's why I used to say that if you are writing FR should not be something that is difficult for you. You should just go there with confidence, write, and come out. It's very simple. How can they ask you to go and prepare what is it called? Statement of profit or loss, and as financial positions, changes in equity. The only one that is a bit technical is the cash flow, which is also very simple. And then when you do it, you come out and then you are just smiling, and then you are, because they will just be marking your step. They will just be marking you, and before you know, you have gotten 50, you have passed, and then that is it. You understand? So please, FR is very simple. All that you need to know is all I have told you.